When an investor buys a standard option-free bond, they are entering into a highly rigid contract. The borrower promises to pay a specific interest rate over a set period, and once signed, that yield locks in. But a fixed payout leaves the investor exposed. If macroeconomic inflation spikes, the purchasing power of those fixed returns is destroyed. The investor still receives the exact dollar amount agreed upon, but that money buys a fraction of what it used to. Conversely, if the borrowing company achieves explosive exponential growth, the bondholder is left behind. The company's equity value skyrockets, but the debt holder is isolated from that upside, receiving only their initial modest interest rate. To solve this rigidity, financial engineers use embedded options. These are modular clauses inserted directly into standard debt contracts, allowing the bond's terms to adapt as market conditions shift. To survive dynamic markets, investors can't rely entirely on simple, static debt. By using embedded options, they mathematically adapt their investments to protect against the downside while opening the door to future upside. Floating-rate bonds offer a direct defense against inflation by allowing the interest payout to rise and fall alongside market rates. But letting a yield float freely introduces a dangerous new variable: extreme interest rate volatility. This chart tracks a floored floater, an embedded option designed to control that volatility. As the general interest rate plummets, the bond's specific yield hits a minimum floor and flattens out, guaranteeing a baseline return even if central banks drop rates to zero. Looking at the other side of the equation, a capped floater protects the issuer. If market interest rates unexpectedly spike, the bond's yield hits a hard ceiling. This strictly limits the maximum payout the company owes, preventing them from being crushed by soaring borrowing costs. These caps and floors act as engineered guardrails. They allow both parties to participate in the benefits of a floating rate while establishing absolute worst-case scenarios in writing. This flexibility can be applied to equity participation through the ultimate hybrid asset, the convertible bond. A convertible bond contains an embedded call option, giving the owner the right to exchange their debt for the common shares of the issuing company. A specific conversion ratio dictates exactly how many shares the bond can be swapped for. To accurately price a shape-shifting asset like this, analysts use the arbitrage-free valuation framework, which relies heavily on the principle of value additivity. Value additivity states that you do not price the bond as a single monolith. Instead, its total value is calculated as the sum of its straight debt and the embedded option it carries. Because of this split, the convertible bond has a built-in safety net. Its minimum market value will always be the greater of its straight debt value or its equity conversion value, whichever weighs more at any given time. This binomial interest rate tree shows how financial engineers value these options. Focus on the equations below. By calculating straight bond value and subtracting the callable bond value, analysts isolate the exact price of the embedded option. In modern finance, pricing complex hybrids isn't guesswork. Analysts use value additivity to deconstruct these assets, pricing each internal mechanism like individual Lego blocks. To test how effectively these building blocks warp traditional risk, we can evaluate the convertible bond against pure equity across three extreme market scenarios. First, a stock crash. A pure equity investor absorbs the full catastrophic loss of the falling share price, but the convertible bondholder hits a hard stop. The straight value of the underlying debt acts as a strict safety net, limiting their downside risk. Second, a stagnant market. If the stock price flatlines, the pure equity investor earns nothing. The convertible bondholder, however, collects steady, guaranteed coupon payments, generating a positive return while the stock goes nowhere. This chart visualizes the returns of pure stock versus the convertible bond across all three scenarios. In our third scenario, a roaring bull market, the bondholder exercises their embedded option and captures the equity's price appreciation. They will slightly underperform pure stock returns due to the initial conversion premium they paid, but they actively participate in the massive upside. Embedded options break the traditional binary rules of investing. They create intentionally asymmetric payoffs, protecting the investor on the way down while keeping the door open on the way up. Through the arbitrage-free framework of caps, floors, and convertibles, investors don't have to accept what the market hands them. They can mathematically engineer their exact desired exposure to the future.